Hello, everyone. Welcome to today's webinar, where we will be discussing international credit risk management. I am Manal Mifraj, and I will be moderating this event today. I come from a trade credit insurance background, starting with the Euler Hermes, then at Radius and QBE, plus COFAS. Now I am the CRM manager in Etihad Credit Insurance. I would like to thank you, our guests, to join us in the webinar today, and to join the discussion on credit risk management. We will have Angelica Assaf, the head of data strategy in Cedar Rose, Larry Beagle, the managing director of Forms International, and Milton Nabendi, the financial controller at Petronas Lubricants International, and Armendra Saulani, the managing director at Smile Computers. Thank you, our guests, for being on the panel, and please feel free to introduce yourself. We can start with Angelica.
Okay. Hi, everyone. I'm Angelica Assaf. I am the head of data strategy at Cedar Rose. I started with Cedar Rose as a credit analyst 10 years ago. And today with the data department at Cedar Rose, we work on acquiring data from hundreds of sources to have the most comprehensive database, especially in the MENA region, with more than 42 million records of business information. In addition to that, we have connection to more than 200 million records to bring to the table a global coverage to our customers. And we go all the way through structuring the data, standardizing, cleansing, and translating it to have the data ready to be digested by our analysts and our clients. And we also apply several AI techniques to either get insights, apply prediction models, or even automate some of the work. The floor is yours, Laurie.
Thank you very much, and either good afternoon or good morning, depending on where you're speaking from. I'm in the UK, near Manchester. My name is Laurie Beagle. I'm managing director at Forums International. The Forums International have been around for 7 years, but we've actually been running forums over 20 years with various partners like Dun & Bradstreet and PricewaterhouseCoopers. My career started as a credit manager back in the IT sector, and has moved on from credit management to business information, consultancy, training, and credit and industry forums, which we run in the UK, Europe, and globally for credit and finance professionals. We have members across the globe, and who virtually trade in probably just about every country that you can think of, I suggest. Credit risk is a very, very much a subject which is on our agendas almost all the time across all of the forums that we run, especially in our order to cash forum, which is a new one to our portfolio. I'm an international speaker and regularly quoted in the trade press and online. I'm a fellow and vice president of the UK Chartered Institute of Credit Management, and also an associate of the Association of Certified Fraud Examiners. And my mission in life is to provide professionals with a reliable source of information and knowledge. Anyway, I sincerely hope you enjoy the webinar today and get lots from it. Thank you very much.
Thank you, Larry. We can give the mic to Dharmendra.
Thank you, Manal. Hello, everyone. I'm Dharmendra Sablani, and I have been part of IT fraternity in Dubai for the last 27 years. Worked for one of the largest IT distribution companies before starting my own IT trade business about 22 years back. I have also been on board of Dubai Computer Group, which is an association of IT companies in Dubai under the umbrella of Dubai Chamber of Commerce. I've been on board for last 7 years, 3 years as general secretary, and last 4 years as the president of the group. My key role in my company is to oversee HR, cash flow, and credit risk. And as a president of Dubai Computer Group, I have been actively involved in promoting proper credit risk management in our industry and lobbying with banks, credit insurers, policy and advocacy teams of Dubai Chamber, Dubai Economy Department, Dubai Customs, and other government departments and quasi-government bodies. So my experience predominantly is in our IT industry, and whatever I speak and say today would be with in connection to the IT industry and the credit risk involving the IT industry in UAE. Thank you.
Manal, you are
Thank you,
muted.
Dharmendra. We can give the mic now to Milton. Milton, thank you for joining us on the panel.
Thank you, Manal. By names, I'm Milton Navende. Currently, I work as the financial controller for Middle East, Africa, and Turkey in Petronas Lubricants International. I started my career in Ernst & Young, one of the big 4 audit firms in the Kampala office. And then from Ernst & Young, I joined a telecom group company, which is called Lap Green N, which was a telecom arm of the Libyan investment portfolio. So I was based in Dubai at the head office, the group here. We had subsidiaries in Africa, mainly in different countries in Africa. Then from Lap Green N, I joined Petronas Lubricants International, where I am today. And in Petronas Lubricants International, basically I'm in charge of leading the finance teams in our subsidiaries in Africa, Middle East, and Turkey. So I have about 5 subsidiaries that I take care of with the finance team seated there. And of course, being a finance focal, we are having interaction in relation to credit risk more often than maybe a number of other departments. So that's basically how my involvement with credit risk pertains. Thank you.
Thank you, Milton. Thank you all for the introduction. And I would like to mention that this webinar is organized by Cedar Rose, who are a credit risk management solution company with offices in Cyprus and UAE. Cedar Rose has over than 25 years experience in providing insights and data on companies worldwide, and most of the insurers and banks in the market, they take their information reports from Cedar Rose. Thank you, guests and speakers, for being on the panel. And we will start with the first question. Our first question will be, how would you define what a good credit risk management process is and what benefits it brings to an organization? We can start with Angela.
Okay, I think I was muted. Well, from my opinion, a good credit risk management process should be a fair, transparent, and comprehensive assessment of the customer's risk, while ensuring the internal process and resources fully comply with the organization's vision and long-term objectives. As for the benefits, well, credit risk management process, it is a very critical protection for any company dealing with payment terms. Not only it helps protect against defaulters, but also it protects the overall company's profit achievement. For example, if we have a customer who defaults fully on $100 transaction with a gross profit of $20, the company does not only lose the $100 revenue, but to cover the loss, the company must sign 5 similar deals at a 20% gross profit to balance the financial statements. So in conclusion, defaults also put pressure on the company's resources in terms of employees, supply chain, and others to make to work more to cover the loss and to also break even at the end of the day.
Thank you, Angela. Dharmendra, you can answer the question as well.
Sure. Well, I'll answer it from a business point of view. We as a business believe that there are three core areas to focus on proper credit risk management as such. One being the company's internal risk management. So robust KYC process and norms along uh, with good market intel. I mean, it's very important to have a good market intel. Unless you know what is happening in the market, it's very difficult to understand how your customer is behaving as such. Secondly, being the external sources for additional comprehensive and mass market or customer information, someone like Cedar Rose, for example. And finally, actual credit insurance. In case one does miss to spot a bad credit, you want to cover yourself for that bad day. So these three fundamental areas put together, I feel if a company does take a proper balanced approach with these three options and deploys their resources appropriately, then the reward is business growth with a low or zero bad debt, which ultimately helps us improve the bottom line of a business significantly, especially in a scenario of the way the trade is done in this region. It is really helpful.
Thank you, Dharmendra. Thank you. Laurie, maybe you'd like to answer the question?
With pleasure. Well, we all live with risk every day of our lives, and taking risk for companies is good, providing it's controlled. I think we all need to understand that a risk process, there isn't just one risk process. There isn't a one size fits all. Risk management processes need to be developed with input from all of those involved in the company, all of the parties. It's not just a credit-driven process. It's got to be from sales, it's got to be from logistics, it's got to be from finance. It needs to be all of the departments that are involved. The benefits of a process, which is a process controlled risk, is that at the end of the day, hopefully you'll sell more and there'll be less bad debt.
Thank you, Larry. Milton, would you like to add some insights to this question?
Thank you, Manal. I think I completely agree with all my colleagues, what they say about what a good credit risk assessment system would be. I think if I were to add, of course, one of the things is in the world where we are today, we need agility in making decisions. So one of the key things, you need to have a system that enables you to make that decision soon enough when you need to make it. Because more than often in the business, I see this a lot, most especially, being in a trading business, and you get opportunities that come, most especially in parts of the world like ours of Middle East. You get this potential customer, and you need to make a decision whether you need to proceed with the deal, whether you need to give them credit or not. And more often we spend a lot of time trying to debate, do we give them, how much do we give them? And when you have a decent system in place that supports you, then you are able to make those decisions much faster. And that gives you an edge against competition. You make decisions much swifter, and that helps you as a business. And when I look at the benefits that you would get, from having a good system, of course, one of them is what I've just mentioned, ability to be agile in making decisions. The other thing is, of course, it gives you cost savings. I give a typical example. For example, for us, when we are in trading, you're having a customer coming to you and you're thinking, do I ask this customer for a letter of credit or not? When you ask for a letter of credit, there is a financing cost associated with it. But when you have the right intel and the right information to make you make the right choice, you find that there are some costs that at times we go into because of being paranoid or being fearful of the unknown. But when we have the right information, we can then make those decisions that enable us to make those savings that at times we actually just leave on the table.
Excellent, Milton. Thank you so much. And the next question, it will be for you as well. So, Milton, we would like to know what are the key components of credit risk management, especially with regards to international customers?
Yeah, thanks, Manal. I think, of course, when we are talking credit risk, the first element we are talking about, most especially we are talking about the international customers. One component is the country profile itself. So, for example, in our company, we deal with clients coming from all over the globe, so mainly from Middle East and Africa. You find certain countries, the risk profile of a certain country is much lower than the risk profile of another. You find in instances where even when the customer themselves are creditworthy, the conditions in certain countries make it difficult for certain payments to come out. You find some people can't make foreign currency payments, some people can't make certain payments because of certain rules in certain countries. Now, this is a key element when you're doing credit assessment. You're also not just looking at only the customer, but you're also looking at the market where this customer is seated, because it has an implication on that customer's ability to pay. And of course, the second one, which is a very important one, is the profile of the customer. Who is this customer? What is their payment trend? Also, it's about what is their payment history. Do they pay other suppliers promptly? Do they have the tendency not to pay? Because some customers, you can look at financials of a customer. They are very healthy, but historically they are just never willing to pay, because remember, at any point when I have money, I'm looking at what's the best benefit for this money. Do I pay now? Do I invest it somewhere else to get much better return? So all these are playing into the risk profile of a customer when you're assessing the credit risk.
Thank you, Milton. And the next 4 questions is related to the current economic situation that we are facing in the meantime in all the world. We will start with a question to Dharmendra. Have you witnessed any change or behavior from the international customers over the last 2 years with the multiple crises we have faced, the COVID-19, the high inflation rates, and recently the war in Ukraine? What's your experience with international customers and their behavior?
It's a very important question in today's time. See, the multiple crises that I will answer on behalf of my industry, because I'm not an expert in general on how the world has been shaping up around these crises. But as far as these multiple crises that you just mentioned, they have actually worked in favor of our industry, IT industry as such, especially in case of distribution and trade of components and devices. Pandemic has been instrumental in increasing the device base. The base of devices has increased, whereas we used to have 1 or 2 laptops in a house, or you would carry the same laptop between your house and work. Now the device base has gone up. If you have 3 kids in the house, they have 3 laptops with them because they need to study remotely. So this pandemic actually worked as a blessing for the industry. The device base went up. Every home or office, like I said, now has more devices than the pre-pandemic. So the demand base of these devices has gone up permanently. It's not a temporary increase, but it's a permanent increase for us. Along with high demand, constraint on supplies has helped keep the margins also healthy. Our industry was generally known for very low margin businesses, and it was very difficult to keep up even in the single digit margins. So this pandemic helped us increase our margins also. And being a basic necessity for any business, school, or government department, IT industry, and especially mainly the endpoint devices, are not too affected by these. The demand is not too affected by these inflationary pressures. The demand has still been consistent so far. I mean, I don't know how things will shape up. War in Ukraine is a cause of worry for us also, and we hope that we expect that it comes to an end soon, as there is a lot more business at stake because of this war. Because of all these reasons, I feel our sector did not feel the pressure of credit risk because most of the companies were in a healthy situation. And in fact, customer behavior had improved. It was more positive for us until, I would say, March, April this year. It's just that now, last 2 3 months, that our industry has started feeling the pressure of oversupply because all the orders which were pending, excuse me, all the orders which were pending with the vendors because of lack of manufacturing facilities, they've started coming into supply chain uh, all at once. So now we have started feeling the pressure of oversupply. Now the pressure of inventory will force companies to sell at higher credit risk to the higher credit risk customers. So now is the time to see and watch and see how things shape up now. So it is very important that we work very closely with our business partners and avoid the pitfalls of overstocking and overexposing our businesses to the bad credit. So now actually our test period has started. So yeah, maybe we'll come back and say that how it shapes up. So far, it has been good for us.
Yeah, I
Thank
think it was the best for the IT market
Yes,
worldwide.
it was. It was.
Excellent. Thank you, Dharmendra. Thank you. So I believe the next question is for Larry, and it's about customers again, international customers. So do you believe companies dealing with international customers are currently taking extra measures with regards to the risk of longer terms and slower payment morality?
Well, the quick answer is yes. I think the key to this is no. I think we mentioned it earlier. I think Milton mentioned this earlier. Was about KYC, knowing your customers, but also knowing your customer's customer. In the current environment, I think yes, a lot of our forum members are telling me that they've actually changed their processes and built in some stronger processes with existing customers, perhaps where there was a medium to low risk. Perhaps they're just doing perhaps some more monitoring, looking at them perhaps a little bit closer than they were previously. But back to this knowing your customer, keeping in touch with your customer, and is very, very important. New customers, we've got our members are trading, as I said earlier, trading around the world, and including Ukraine and including Russia, certainly in the telecoms markets. And they are finding it difficult. And of course, in some areas, they're not getting any money out at all. So I think they are saying that they are still doing all those normal checks. They're getting the Cedar Rose report, of course, which is very important. But also making sure they know where they're located, who they're selling to, and understanding their market. That's a very, very important part of that jigsaw puzzle. And also, I think the final thing is risk teams are starting, or have been for years, but I'm seeing it more these days. They're starting to talk to their counterparts in other countries, other companies, and other countries. So getting that intelligence on what exactly is happening on the ground, and not giving secrets away, but just sharing those trade experiences is very, very important. So that will be my answer.
Excellent. Thank you, Larry. Thank you so much. And now we will go back to Angela with a question as well related to global competition. So with the increased global competition, is there a risk for organizations to fall into a fraud trap onboarding new fraudulent international customers without conducting a comprehensive due diligence, including credit risk assessment?
Well, at Cedar Rose, we have seen an increased number of fraudulent behaviors during the recent credit risk investigation for our clients. And in the last 2 years, COVID, as well as supply chain challenges, have enabled new fraud to appear, especially when onboarding new clients. I will give you an example here in UK. So during COVID, for example, 2 fake companies, they have received around £180,000 after falsely claiming to supply personal protective equipment, which is used for COVID detection, and they have been shut down later on. So this was one of the examples of how and from different perspective of the increase of fraudulent activities. Now, other cases we have also recently heard from our clients and confirmed during our investigation. One of the examples is changing the company name, or even intentionally have the name misspelled to avoid being caught as a sanctioned entity. And here, this doesn't only apply on the company name, but also on the shareholders' names, which are related to the company. Especially when you are translating from the local language, which could be like different than the English language. I will give you an example here. Translating the name Muhammad, for example, from the Arabic language into English language can have like different variants. So you can have it misspelled in English, language, and this will not get you caught from PEP screening and or other screening processes. Another example is document falsification. They can use now Photoshop to get better credit assessment. And when I talk about documents here, it could be trade license document, it could be financial statements, and other examples as well. A third example is purchasing of old companies. So this is a weird example, but it happens. So there are some business people there who purchase old companies that are no longer in business. And what they do, they update the trade license and modify the activity code or add an activity code. It helps suggesting that the company has been in the business for a very long time, but in reality, the business, they have just bought an existing company just to do the activity that they want to do today on the ground. So these are very few examples of many other examples in real world which are happening and increasingly happening in terms of fraud. So there are also new legal requirements from government authority. So a credit risk assessment today on your customers or clients is no longer enough. It is now requested to perform KYC checks, compliance checks, enhanced due diligence also on the companies and businesses, and also on the related shareholders and UBOs. The objective is to make sure that you do not do business with any sanctioned entity.
Excellent, Angela. Thank you so much for the insightful information, all of you so far. I believe now we will go back to Milton. We have a question for you. Have the current macroeconomic conditions put a curb on multinational organizations' internal strategy to onboard customer faster? What do you think?
Thanks, Manal. I think the answer is yes, right? And just looking at adding on to what Angela just mentioned, the regulatory environment has actually changed a lot. I remember when I was still in Ernst & Young and we were doing audit, and one of our first clients was a bank. And when I looked at the KYC form for a bank, I saw it as a very complex document, asking for a lot of information that I didn't understand why they asked for it. I'm giving my money, why I ask all these questions? But when you look today, actually almost all multinationals are doing this kind of thing because the regulations have changed. Now we have lots of sanction regimes. You have the US sanctions, you have EU sanctions. Recently I had China has sanctions as well. So the sanction regimes keep increasing day by day. And that just creates a trap for a lot of organizations, and most especially the multinationals. And to stay safe, they have to make their KYC processes more robust. And now it moves beyond just talking sanctions. We are also talking about political exposure. So when companies are onboarding customers, they are looking at things like, is there political exposure with these customers? Is there negative press? Because all these things play into the company's reputation and image. And with all these things coming into place, it has actually made the process more complex to onboard a customer. It's no longer an issue of a salesperson coming up with a potential client and then you conclude the deal. There's lots of background checks we need to do. Unfortunately, when you think about the current environment and some parts of the world, some of this information is not readily available. So for example, if we are dealing with customers from Middle East, Africa, Jordan, Kuwait, every country. So you get a customer that's coming on board, and then you need to get information about this customer. And you ask yourself, where do I start from? Because even when you try to search the customer on the web, you don't get a single feedback of what this entity is, So such situation, but yet you are having sanction regimes that require you to know who you're selling to. And in fact, it does not even stop at who you're selling to. Sometimes it extends to who that person will sell to as well. Because your product, you might sell to a legitimate customer, but then that customer sells to another party that is sanctioned, and before you know it, your products are in the hands of a sanctioned entity, and you have all these things to deal with. So I think the macro environment has made it a bit more difficult for the multinationals to onboard customers. And I think that's when now we need to think of relying on tools, like I talked about. When I get a customer in Jordan, I get a customer in Sudan, I get a customer in any country, how do I get the information to enable me get that comfort that, I'm not trading on wrong grounds?
Excellent, Milton. Thank you. Thank you so much. So we have, from the audience, we have one question. Maybe, Dharmendra, you can help us in answering this question. How would you manage a credit volatility risk in the current era of this crypto world?
I didn't really exactly understand what the person is trying to ask the question. The crypto volatility I do understand, but how does the credit risk work along with that? I didn't understand that exactly.
Okay. Maybe Shuaib Azhar, maybe he will come back with more explanation to the question.
Detailed explanation.
Yes. In the meantime, we will, I think, yes, Dharmendra, would you like to add anything?
I just wanted to add something to what Angelique said earlier about how do you manage the risk in this current competitive scenario that you told her, knowing your customer. I feel that all the credit risk providers, service providers, whether it is insurers or credit risk management companies, working with industry experts or industry closely does really help in some way or other. Like Milton also mentioned that we don't know the company in Jordan, how do they function, what do they do. So if they are associated with the local trade organizations, it can be an helpful situation, and it could be helpful in that situation. I mean, Cedar Rose has been very proactive in that. They have approached us, and we definitely intend to work very closely with them. But that could be one more area that you could focus on, and it could be a very helpful situation, because an industry expert and insider would know if the numbers that you are seeing on their balance sheet that they've given you seem to be genuine or not. So that's one more suggestion that really could help.
Thank you, Dharmendra. Thank you. I believe we're going to go ahead with other questions. We have another 4 questions for the challenges that mainly most of the corporates are facing with the current situation. So I believe in the first question, Dharmendra and Milton, you can support us with your insightful response. What is the number 1 challenge you face when onboarding new international customers, and how do you cope with it currently? I believe it's a question also related to the KYC procedures and the previous discussion about how do we onboard international or domestic customers.
So I'll take it first. See, the thing is that it is a constant challenge, especially in this region where there is absolutely no visibility, as Milton already mentioned. There is no visibility of customers' financial health. So no matter what I do, I have to rely on the information that they tell me, that they give me, or that they give to credit insurers. So honestly, we have to rely on our market intel. Like Laurie also mentioned earlier, it is not just a credit department's job to manage the credit risk. So whether it is our sales team, our purchase guys, people on the floor, people on the ground, they do provide intel into whatever they can gather from the market. And we have to rely on the market intel and the experience to really navigate through this rough ocean of credit risk. Moreover, since the law also does not mandate companies to publish their data, and there are enough players who are willing to take high risk in this, it is a huge challenge. Like you said, because of competition, there are very too many players in the market who are willing to take this high risk and start the credit with an unknown customer. But for us, if we don't get credit insurance, then it is to start with the smaller limits, and after good market intel, speaking to some of your existing customers. But yeah, ultimately it boils down to credit insurance. Ultimately, if we have to do big business.
Thank you, Dharmendra. Maybe Milton, would you like to add a comment on the question?
Yeah, thanks, Manal. I think, as already mentioned, I think one of the biggest challenges is actually lack of information, because even when you get the information, even when you get it, either the quality is not the best that you can actually make meaningful interpretation, or even when the quality is good, in some cases you don't have the local market intel to enable you make the right interpretation of that data. Like Laurie mentioned, for credit risk assessment, it's not a one size fits all. You can get sets of financials with similar indicators from the financials they have in similar indicators, but they pose to you completely different credit risk ratings because of the market where they are, because of the trends inside that market, because of the practices inside that market. And as the Mandra mentioned, so that's when now people that have insider information in that market and have intel of how that market works help you to navigate such situations. Otherwise, it becomes very complex, because we've had instances where we get good financials and they check all the boxes. But then 2 months down the road, you get a default and you ask yourself what went wrong. But it's because there is inside information inside the market that you're dealing with that you could not anticipate. There are also regulatory changes. For example, I'll give us a market like Egypt. You go to Egypt, you will get lots of unwritten rules very many unwritten rules. So if you base on what you see that's written, you actually get it completely wrong, because you do a transaction. We've done transactions where you reach one level, they say, oh, you needed to get central bank approval, you needed to get this, but it's not clearly written in a particular document that you can sit down and do. The only way to navigate those is have people that have intel inside the Egyptian market that can facilitate you to make those decisions.
Thank you, Melton. Thank you very much. I think the next question for Angela is related also to the comment we got from Dharmendra regarding the availability of information in the market and how confidential is information in the market. So, Angela, how would you rate the access to reliable data on international customers to build trustworthy business relationships? We understand it's different from a region to another, but we can have a general view.
Exactly. Well, there is definitely a lack of transparency and access to publicly available data. I will also highlight Egypt in particular, not because Melton did, but because there's also another challenge from a different perspective, for instance, in Egypt, which is to find the information on the businesses. It's not really available to the public. And even if you manage to find information on business registration, for instance, from the authority, the data is in local language, so you need to have translators or to translate them. And it is in unstructured format, like PDF format. So you need also to apply some OCR techniques in order to extract the data from the documents and have them structured, and then apply the translation, and then have the data for you to be able to work on it. So this is one example of the availability and accessibility of the information. Another example, which I would also like to highlight, as Melton and Dharmendra said earlier, is the knowledge of the local market. For instance, if you don't know UAE enough, you wouldn't know that in UAE you have more than 20 or 30 jurisdictions, and every jurisdiction has its own business registration authority. So if you have a company registered in UAE, you must know in which jurisdiction it is registered in order to, verify the information, or else you will need to go and cross-verify with all the 30, maybe 40 different jurisdictions. Adding to that, as Dharmendra also highlighted earlier, there is no enforcement to publish financial information in most of the countries worldwide. So it's not only in the MENA region, also in the US. If you go there and you want to do a credit reporting on a US company, it's very, very challenging to find financial information on these companies, as companies are not even required to file their financial statements. So, even if you get to find some financial information on the company, you need to make sure that the financial data is fresh, so it's up to date. It's not like outdated for 2 years or 3 years ago, which will not really be useful for you to assess the company based on that. There is a necessity to rely on expertise and experience people to assess the credit risk of a company, using other parameters such as ownership structure, the entity hierarchy and ultimate beneficial ownership, the activity of the company compared to the market, the historical information that you can get on a company, the industry, the country risk as well. And there is also a necessity to rely on alternative data to fill the information gap and help you determine if the customer will be in a good financial position. And by alternative data here, I mean any information which is different than the traditional data, but could add a real value to your assessment. It could be, for instance, social media sentiment analysis. It could be the business website traffic. It could be payment data and trade reference checks. So this is from my perspective.
Thank you, Angela. Thank you very much. And so far, we have very insightful information. I think everybody's enjoying the webinar. We have 15 minutes left to finalize our question. So the next question is for Dharmendra. Does your organization face any challenge during this time, during your credit review, to stay on a top high risk customers accounts?
Well, yes, that is always a challenge. That is always a challenge. Now, but fortunately for us, the situation is such that we, being in a B2B business wherein we trade with our customers on almost daily basis, we are in touch with our customers almost on daily basis. If we are not closing deals on daily basis, we are definitely talking to them on daily basis. So that somehow keeps us in the loop with the customer. We are able to understand their buying patterns. We are able to understand their payment cycles. It's more flowing. The flow is much faster and much. So any change in the behavior of payments, or whether it is their buying patterns, whether it is how they manage their inventory, whether they are liquidating their inventory at a much faster pace. We have visibility into all these areas of our customers. So that helps us significantly to stay on top of our customers, understanding of the business. Secondly, the only challenge that we face and we need to keep on top of is their regulatory requirement, regulatory processes. For example, if there is any change of partner, change of ownership, that is something that we need to be very careful and aware about. Recently, there was a case and situation in Dubai wherein a company, the partner, took the name of the trade license about a year and a half ago, and they defaulted recently, as recently as about maybe a month ago. So that was a situation which caught everyone off guard, because if you know that the same person, same company has been doing business, it has been, everything is steady, everything is same, although there were some signs of some problem over there, but then again, the owner is the same. But if someone had known that the owner had removed their name from the trade license, so these are things that we need to be more careful of. Rest of the things, as far as our B2B business is concerned, we are in touch with our customers more regularly and are able to understand their psyche much better.
Thank you, Dharmendra. And now we'll go back to Larry with a question about organizations in the same sector. So why are organizations active in the same industry and sharing the same customer base not working better together to transparently exchange payment, default data, and information? So why they don't share information if they have especially bad payment morality information?
Thank you for that. Just going back on the question that was answered just now, I believe building a risk picture is a bit like a jigsaw. It's having all of the pieces in place. Unfortunately, sometimes you've lost some pieces down the back of the settee, and so you never ever have them all. So I think having those your personal networks and having access to all of those other sources of information will help you build that risk picture. Anyway, so just a little aside there. But no, back to sharing of information. In sharing of information, it does happen in a lot of industries, but there is some skepticism about it and some nervousness. And in fact, it does take a long time to build up trust. In one of our forums, we've been sharing experiences for over 20 years. But we've had to jump through many, many legal hoops and across a lot of international borders. So it's been very, very difficult. And now we have to keep it constantly under review. And I'm the policeman at our meetings to make sure that people do not say the wrong thing and do the wrong thing in practice. There is a lot of concerns that sharing trading experiences may have an impact on business. I suggest the opposite is true, actually. I think if you do it in a controlled manner, then there is only goodness will come out of it. But there are areas of no go. And those no goes are we can't talk about pricing, we can't talk about terms, but you can talk about historic items. And so trading experiences are normally historic. So what happened and how has somebody been trading with you? Those experiences, that history, actually goes a long way to making towards your decision on future trading. So I think people shouldn't be afraid of sharing. It is good, and my bottom line is sharing is goodness.
Excellent. Thank you, Larry. Thank you for the answer. So we have to involve technology within our questions. This question is for Milton and Dharmendra. You can add your information on that. How can new technologies support and simplify the credit risk management process? And what's your organization's strategy on that?
Thanks, Mana. I'll take this first. I think with the increasing challenges that we get with credit risk assessment, new technologies actually give us some relief. So when we talk new technologies, we are talking about a number of elements, right? One, we have data gathering capabilities, but also we are having technologies that can then give us some predictive indications of how credit risk could turn out. I've heard of companies like Cedar Rose that do algorithms that then project, and based on certain industry indicators, they can do some predictions for you on how credit risk is going to turn out, how much credit you should give to a certain customer when they come on board. So I think these new technologies, as they come up, they help us make our credit assessment much better. And most especially when they are able to enable us do some technologies, do some predictions about the credit risk. I think that gives us an edge when we are making assessments on our customers and having the credit risk assessment done.
Excellent. Thank you, Milton. Dharmendra, would you like to add a comment on that?
Yes, sure. Like Milton did mention about some standard rules and guidelines to be provided by companies like these, I somehow believe that credit risk is beyond that. Why I say, because I'll give you an example. In 2016, when our industry was, not only our industry, but even food industry and other industries in Dubai were going through a rough patch, I received a notice from my insurer saying that they are reducing 10% credit across the customers. Now, that is a very, very basic or rudimentary way of managing credit risk. The idea is to remove bad credit from the system, not reduce the credit exposure across the good credit also. So a general application of such rules somehow I don't think really works very well in credit industry. Now, coming to how technology plays a role, I feel that technology can be used as an enabler. I completely agree that data management and data mining is an important aspect when it comes to technology. But I feel there is more important role that can be played by different stakeholders in this whole scenario. More of data management and data sharing, like we discussed, can play a more significant role. It is more about collating and sharing of data than that of technology, because that is the underlying thing that you need even for the technology to be able to play some role. So it is transparency and educate data, as I feel, to make that is what will help us to make informed decision, and that is what is lacking. And like even Laurie mentioned about, there are some no-go areas when it comes to data sharing. There are some personal, what do you call, I would say personal motives also that stop us from sharing data as an individual company. So I want to cover my risk before I share any information with anyone else. So that time could be a deciding factor if the company will stay or will be a default. Secondly, if I share any data, that could hamper the company which is in a temporary situation, in a temporary problem, and could further derail the recovery process of that company itself. So it's a very difficult situation to be in. It's a very difficult situation to be. Thanks, Laurie. Thanks, Mana.
Thank you, Dharmendra. And now the question to Laurie. How important is data access and coverage to uncover credit management risks with international customers?
I'll keep this very brief.
Yes, please. Thank you.
Very important. I think without the data, you're making decisions blindly. And back to my jigsaw again. Without having all of the pieces, you can't make a good decision. Maybe it's a strategic decision that you're having to make if you haven't got all of the facts. Of course, I mustn't forget our friends in the credit insurance market, who actually can help as well, bring data and experiences and information to those risks as well. So yes, it is very, very important to have that data available. Otherwise, as I say, you're just making decisions blind, and blind decisions are going to be equal bad debts.
Thank you, Laura, for the insight information. Angela, we have the last question in technology for you. So we often hear about the differences between developed and emerging markets with regards to data access, which we discussed a couple of minutes back, and the transparency of information. So what you can easily find in the UK would be an impossible mission in the UAE, for example. How do you address objections from organizations maintaining it too risky to do business with the emerging market customer? And can technology close this gap?
Well, I will start with a small joke, because when I heard you saying what you can easily find in UK, which is impossible in Dubai, and having lived in both countries, I would say the weather. But going back to the credit risk assessment, well, it's true. Information availability and transparency is very complicated, and is in most of the jurisdictions in the world. This is that we have covered, as you said earlier. But doing business with emerging market customers is possible. And that's been Cedar Rose mission since it's set up. So our mission is to build trust and bridging gaps between emerging markets and the rest of the world. But you definitely need to rely on experts who have experience working in these regions. Now, the technology part of it, I wouldn't say that only technology would close the gap, but it can help closing the gap in addition to data sharing, as my colleagues mentioned earlier. Also, in addition to going to alternative data as well, so to top up what you already have. So the more data you have and the technology together, they can close the gap. And technology can definitely help enable faster and more reliable decisions. For example, you can use technology to accelerate the collection of the information, as Milton mentioned earlier. This is where you can use the technology. You can also use it to accelerate and make more reliable analysis. For example, you can have AI models to do prediction on the defaulting level of the business. You can do business clustering, for instance, or predicting some outcomes of the companies, whether you can offer higher credit limits or lower credit limits, instead of decreasing 10%, as Ramendra said, to all the clients. And the use of technology and AI can convert large amount of data into insightful one, instead of having to spend days or maybe weeks to digest the large amount of data that you can have and then get insights out of them. So
Thank you, Angela.
You're welcome.
Thank you, Angela. Thank you, everyone, for your insightful information on all the questions related to challenges or technology or data. Now, I have a question for everyone. What's the best practice can you recommend to our audience, to implement as per your internal policy process? You can just share your main idea about the process in different sectors.
I will start from my end, because I have just shared that in order to close the gap of data transparency and all the challenges that today we are going through, adopting technology and relying on alternative data is definitely a key. And trade reference, for instance, is a key aspect for a comprehensive credit risk assessment for new and existing customers. So access to historical payment behavior insights makes a really difference in order to have a more reliable credit assessment. And this is what we apply at Cedar Rose.
Agreed.
Thank you, Angela. Laurie?
Okay, well, my passing thought is build a process that is fully supported and fits your current business. Make sure it's a need to have, not a nice to have. If you believe in the process, then make sure it's followed to the letter. But on the other side, the world is changing, business world is changing. So keep it under review and make sure the two things fit together.
Excellent. Thank you, Larry. Dharmendra, Melton, you can add your comment as well.
Well, for me, two things, as I said in the beginning only: know your customer, keep a close watch on their business, and secondly, protect yourself any significant uneventuality. I mean, you should be insured against that. That's in two sentences.
Thank you, Dharmendra. Thank you. Melton, would you like to add your insightful comment?
Yeah, thanks, Manal. I think the previous speakers have mentioned it all, but I think what I can just add is that as a practice, we can also try to leverage more on entities that have more expertise in this area to support us as a business. Because sometimes we might not have the capabilities in-house to do some of the analyses, to get some of the intel that we need in certain markets that we go to. So then in such instances, one good thing that we can actually do to enable us make those decisions in the right way is to rely on experts, like Cedar Rose, like other credit rating agencies that can then give us this support to enable us make those decisions.
Thank you very much. And I think we're ending the webinar with this question. So I would like to thank you all speakers for joining us, and thanks for your time. Your information was really clear and direct to the point. Thanks for the comments and insights. We will come back with any questions from the audience after the webinar. We will make sure it's taken care of. Thank you all, and wish to see you soon in another webinar.
Thank you, Manal.
Thank you. Thank you, Manal.
Thank you.
Yeah.
Bye-bye.
Ciao.
Bye.
Bye.
Bye.